Good morning, everyone. My name is Stephanie Paul of Paul's Covered Calls, and I did the COVID pivot, replacing my doggies to dollars. I'm an amateur investor, and I appreciate your time as I share my trades, my story, my thought processes. Good morning, everyone. It's me, Stephanie, and I just wanted to share that I am a real person, and I'm learning some new tricks, some videography, scripts, format presentations, things of that nature. And so this video is actually a combo of 3 other previous videos, so trying to make a more complete story all in one sitting. So this is where your feedback, comments are important because I need to know if this is a better format versus the solo ones. And so this combo video incorporates 3 previous videos, the sell to open, buy to close, and then the actual live trades that show those two techniques all in one sitting. You're making some money in the process. All right, let's get to it. Thanks so much. And again, your feedback is important. Does the combo work? If so, let me know. If not, let me know. That would be great as well. Please comment, please subscribe. Thanks so much. Here we go. All right, the ever important board of dog records. And this is Sweet Pea and myself. And we're going to talk to you about how to open, how to close covered calls, and a situation in which that might apply. Quick disclaimer for everyone, my opinions are my own, my thoughts are my own, processes, etc. are my own, and here we go. Thanks so much. It's a fairly straightforward process, and my dad was a teacher, so keep that in mind. We're going to have a few quiz questions throughout, just to add a little bit of brevity. It's going to be fun. Here we go. All right, so how do you participate in a covered call? First of all, you need to bring some money to the table. This is not margins. This is not a freebie. You need to bring money to the table because you need to own 100 shares. And quiz question, 100 shares equals how many contracts? 1 contract. You also need account permission from your brokerage firm. You need to have done your analysis. Do you even want to get into this stock? And you need to have an options table. So what you see here is an options table. If you don't see this, you can't participate in covered calls. And so what you see here is in the blue section is in the money. There's actually value here. And what I mean by that is right now Ford is at $8.78.5. If you sell a covered call at $8, someone really could technically buy that from you immediately, sell those shares, and get 78.5 cents per share. Again, 100 shares. So they could buy your covered call at 8, turn around and immediately make the money. That's why it's in the money. And here in the white section, that is out of the money. That is future value. And for me in particular, I like to trade at or near the money. Also, as the price fluctuates up or down, this can move on the daily. You could be in the money at $8.50, and an hour later, $8.50 could be out of the money if the share price drops below $8.50. So this chart is not static, it is dynamic. It constantly moves as the price of the stock moves as well. All right, so very simple process to do this. You go into your options banner at the top typically, and then you select a trade. In this case, quiz question, what is the ticker symbol I'm at? Pointing right at it, it's UA, it's Under Armour. And there's a lot of information here. Always an expiration date with your covered calls. The strike price, you definitely look at this. You want it to be a call, not a put. And then from this drop-down menu, you're going to select Sell to Open. and then the quantity. When you're selling to open, you'll notice you have bid, mid, and ask. Selling to open, you're typically in this bid to mid section. Sometimes these numbers are close, sometimes they're further apart. And as you become more confident, you can, because early on I did mostly bid, but as you come to realize you can do 6 cents or mid, and then I tend to do limit, and then over here this is your dollar amount. So again, quiz question, how many shares are in a contract? 100. You get 5 cents times 100, there's your $5. So as you proceed doing covered calls, I started out at the bid, but I eventually progressed here to somewhere in the middle or the mid. And sometimes your contracts may be filled immediately, and sometimes you may need to go in and adjust this price. But I have to tell you, as I've become more experienced with covered calls, I rarely put in the bid anymore, especially if there is 2 to 3 cents between this bid and this mid price designation. So I'm satisfied with this. I'm going to hit with proceed with trade. That's a button that's off screen. And once you've clicked the button and your order has been processed, this is what you will see. Good job, you did it. So your order's been filled, and I just want to share with you some information that is on this page here. You can do that order for multiple contracts at one time. So in this case, quiz question, what is the stock that I traded in? You've got this Tilray. Expiration, the strike price, and the C, all important. That's for a call, not a put. And with this order, how many contracts? It's right there, 2. And I did a limit order of $35, even though it shows 35 cents. Remember, this is a covered call contract, 100 shares, 35 cents times 100 is $35. Last quiz question, how much money did I get in my account for this selling of the covered call? Here's the simple math. 2 times $35, that's $70 in my brokerage account, assuming I don't buy it back, that I get to keep at expiration day, which is right here, December 11th, 2020. Okay, so this concludes selling to open. This is where you're selling your covered call. We're going to proceed here to buying back a covered call. Here we go. So now you have an open covered call. You want to buy that back. You essentially want to close that open position. And for me, I have done this, and 9 times out of 10, it's because my strike price was set a little too low, and I want to keep the stock, and I don't want it assigned. So let's go through this process. So again, in order to buy something back, you already have to have a covered call. You've made the concerted and deliberate decision to buy back that covered call, close that open position, and now you need to go through the process within your brokerage firm to close that covered call position. So here's my window. It shows CGC and my open covered call. And you'll notice I have 300 shares. 300 shares is how many covered calls? There you go, 3. And there's a lot of information here. Expiration date is June 4th, 2021. Strike price right there. What is it? $27. So now you have to go to your options table, and everything needs to be exact. If something is off, whether you have selected for reasons unknown, an incorrect expiration date, an incorrect strike price, typically your brokerage firm won't let you do that. So same thing, you go to your options table, you hit the trade, you're back at the same window. The one exception, this is the same window when you want to sell a covered call. What's different? Right here. Your action is buy to close. Again, you have a previous open position. You're opening to sell an open position, and now you're going to buy it back. This is buy to close. That is the one exception when you are buying to close your covered call. And then here we go. When you buy to close, and the prices that you're looking at are in this area here, the mid to ask, and this is a very tight dollar frame. 10, 11, 12. This is about as tight as you're going to get. And as you go through the process of selling a lot of covered calls, this could be, in some instances, 10, 15, 20. So I just want you to realize this is a tight dollar frame. In some instances, it could be a little bit looser, so you can have a little bit more play when you do your limit order type. Again, my preference is limit order type, not market. And I do that so that I can save a little bit of money here. And again, you have to bring some money to the table when you buy to close. You're actually putting money, you're spending money to buy something back. And this is the range that you're going to be looking at, is in between this mid and ask. Okay, everything looks okay. You're going to hit the process order and dun da da da. Your order has been successfully filled. Again, your order has been successfully filled. And this is what it looks like. Same as before when you sell your covered call. But look at this. It says buy to close. So the previous screen, it said sell to open. Now you're closing your open position. Okay, quiz question. What was the stock? I'm pointing right at it. It's Nikola. June 4th, $18 covered call. And yes, look at this. I had to bring some money to the table. I had to bring $118 to buy this back. And this is where I'm going to tell on myself. I'm not perfect. I did this on a Thursday. And if you go and look at the price of Nikola on Friday, it ended up closing at $18. So technically, I did not need to buy this back. I could have kept the $118 in my pocket, but here's why. Couple of things. One is, at times, and it's rare, but it has happened to me, I have had a stock assigned prior to the expiration date. So number one. Number two, Nikola is very volatile. So it approached 18 and a few cents over. The relationship is, as the stock price goes up, the value of the covered call goes up. So my thought is, this is a volatile stock. On Friday, it could be $20. So if I wanted to buy this $18 callback, this $118 on Thursday would have been cheap compared to trying to buy this back on Friday. And again, we don't have foresight, so I made the best decision with the information that I had at the time, and I bought this back, and I'm glad I did, because the following week, you can have yet another covered call. So sometimes you put some money on the table, sometimes you don't. In this case, I'm glad I did, and I get to start all over again. Okay, so we just completed sell to open, buy to close. The third portion of this is coming up is rolling out and rolling up. And I'm going to show you how I did these transactions and made yet more money during a price spike. Here we go. So rolling out and rolling up is a technique, and I'm going to show you the book right here. One moment. Okay, everyone, you should be reading constantly, and this is one of the most recent books that I've read, and it's Alan Ellman's Complete Encyclopedia for Cover Call Writing. And this is what the technique I'm going to show you is in his chapter of exit strategies. So again, you have a covered call, you decide to close that position, and in this case, I am then going to roll out of my existing strike price and roll up into a different strike price for a future expiration date. Here we go. All right, welcome back. We've got candlesticks and we've got a stock, CLVS. And this happened on a Friday, March 19th. Special note, there are something that is called a triple and a quadruple witching Friday, and this happened to be it. And so this candlestick was up at that $10, $9, $10, $11, blah, blah, and then cruised at 5 or 6, and then hit this witching Friday. And look at that candlestick just outside of the Bollinger Bands, outside of the moving average. It just spiked. And the low was $6.36 and the high was just shy of $9. So the previous slide was on the daily. This is from my TradingView account, and these are candlesticks every 15 minutes. So you'll see opening of the market over $1, another $1, a little bit of retraction, heads into lunch, heads up another $1, and then just does sort of retract a little bit, but eventually it closes just under $8. So these are 15-minute candles. And the reason I knew this was spiking is because right here at this $6 mark, I always have a series of alerts. And so $6, $8, my covered call was at $8. So I start my alerts at $6.50, $7, and $7.50. So this particular morning, my alerts just went bing, bing, bing. I knew something was happening with CLVS. Special note, because these alerts were activated, you will need to go back into your system and reactivate those alerts. The reason I mention this is, say for instance, it spiked up to 6 and then spiked down to, the stock spiked up to 9. And what if it spiked down to 550 off the screen here? The following day, you may think your stock may go up to 7 and you're thinking that your alerts were reset. They're not. You have to go back into your system and reset your alerts. And because I received these alerts early in the morning, about this time is when I decided to roll out and roll up of my covered call positions. All right, the all-important money slide. Here we are, March 12th. Things were bland. CLVS was in that $6, and I had an out-of-the-money covered call, $8. It's cruising along, no action, boom. Second thing that happened, price spike. The following week, the 19th of March, I had to bring some money to the table. I closed my 2 open positions. I brought $68 times 2, again, 2 covered calls. So I had to bring some money to the table. So that following week, all of a sudden, that $8 is out of the money. The $8 to buy it back is in the money. And again, I had to bring money to the table. And then I immediately sold, rolled out of my position and rolled up to right here, a $10 strike price that expires, and look at this information, the following week on March 26th. So I was in a position, rolled out, spent some money, but look at this. Because of that strike price, I was able to sell these covered calls at $93. Special note, it goes up to $3. I have a previous presentation dealing with ladders and layerings, and my technique is always to sometimes keep a spare contract. So that's what I did. I kept a spare contract. I kept a spare 100 shares available for an additional contract just in case. And in this particular instance, with this price spike, I was able to roll out and roll up of 2, and then I had an extra 100 shares that I could sell yet another contract. So here I have 3 contracts at $93. So yes, I had to spend some money, but I got a whole lot back. And if you do the simple math, that's $151 between buying back 2, selling 3, and that return is about 5%. And I will do this time and time again. And again, 3 covered calls here because I like to keep 100 shares available just in case I want to have and sell a covered call at a later date for a different expiration date and a different strike price. In this case, it worked out beautifully. So sometimes a spike happens, sometimes it doesn't. But in this instance, I had a tremendous return because I was able to understand that I could sell to open, I can buy to close, and I can make a little bit more money when there's a price spike. And I'll tell you what, that was a triple witching Friday. And guess what? This coming week for June 18th, yet another triple Friday. So I'm going to take a pause. I'm going to look at all the shares that are in my portfolio. I'm going to see how they reacted at the previous witching Friday, which was in March. And I'm going to just do some analysis and determine if I want to get in on covered calls on Monday or just wait for the market to do its crazy witching thing that it does on these witching Fridays. So thanks so much for your time. I appreciate it. Again, my name is Stephanie Paul of Paul's Covered Calls. Please subscribe, please comment, and I do have a Twitter at Paul Called It. So lots of options to communicate, and I hope you enjoyed this 3-part combo series. And it's really helpful to let me know if that was better than the solos or whatnot. So this interaction from you and comments from you will be greatly appreciated and helpful. Thanks so much. More to come, more to share.